clear. Anyway, I'll go through, the preliminary ones first. We all know that, the taxation is to raise, the resources to finance government expenditure. There are many definitions to that, the one which I have picked up, from the Journal of Economic Literature, published in 1993, Burgess and Stearns, the definition or the way he thought what is the purpose of, the taxation in any country. This is all known. We all know that, the taxes are the key sources of government revenue in most countries, except, the few countries who raises revenue by selling, basically minor resources, and few other areas of, the raising revenue, not from taxes. There are only few countries. The other one is that, it is also well known, the macroeconomic conditions affect taxation, and also taxation affect macroeconomic conditions in any country. This is how we manage, the government revenue in Sri Lanka. The revenue organization is very simple. This is, the partly a historical legacy as well. Policy formulation is basically done by the General Treasury, by the Department of Fiscal Policy in particular. Of course, the other department also assists, but is Fiscal Policy Department is the one which is, playing key role in, the making policies. Of course, as per, the country's constitutional law, revenue policies cannot be made by anybody other than the parliament, under the 148 of the constitutional provision. Revenue policies cannot be made by any other authority other than the parliament. Parliament can authorize, any other authority or person or group of people who can make policies on behalf of the government. That is why, although, the Treasury makes, the policies, of course, it has to go through, through Cabinet of Ministers and Parliament to get the final note. The enforcement and collection is basically done by three agencies. The large part of bulk of, our revenue is collected by three agencies in the Inland Revenue Department, the Sri Lanka Customs, and the Department of Excise, and few others subsequently. Olden days, before the reforms were undertaken in early 1970s, the whole government could be mobilized to, the raise revenue. That was, done away with, with the new Republican Constitution of 1972. How is, the policies formulated with respect to the revenue? There are three levels in which, the revenue policies are made by the government. There are those based on, the regulation. Law is already there, under which regulations can be, issued. Of course, the regulations should be subsequently approved by Parliament after sometimes 3 months, 4 months, 6 months, without which, the revenue regulations cannot be, made effective. Second one is, the annual budget, in which, the Minister of Finance, of course, with his colleagues, can, propose, the revenue measures, revenue policies. Again, based on three areas, when it comes to implementation, there are revenue policies, made to put into implementation on that night itself, the midnight itself. There are few that is being made, and there are again, the policies are implemented based on regulation issued subsequently or on the following day or few days after the budget is concluded. Third one is, the third way is that, there are policies that you really require, require certain amendment to existing act or, the completely new pieces of legislation which are suggested at the budget stage. That is the second way in which, the revenue policies are made as per the 148 of the Constitution. Third one is, which is not all that common, based on, the recommendation of the taxation commissions, which we had gone through, several taxation commissions in the past. In mid-1950s, the first taxation commission came in mid-1950s, after independence, which was published as a sessional paper of 17 of 1955. Second one was, the second part of, the 1960s Taxation Inquiry Commission, which was again published as sectional paper 10 of 1968. Third one was, the Presidential Taxation Commission of 1991. Again, it was published as sessional paper 1 of 1990. Fourth one was Presidential Commission of Taxation of 2009, which remained unpublished. From which, the Minister of Finance and Treasury can derive whatever the recommendation, the proposed in those commission reports, I would say the last one, the recommendation was not implemented. The previous ones, the certain parts were implemented depending on the circumstances as well. This is how we manage our indirect taxation regimes in the past. Before 1964, the revenue was largely generated for a long time on, the trade taxation, in particular export taxation. In 1964, the BTT was introduced and it was in effect until 1981. BTT was replaced with the turnover tax, which was effective till 1988. Then it was abolished and, the GST was brought in and it was effective till 2002. And that was again, the abolition, the VAT was introduced in 2002 and VAT is continuing with changes. It was revised about 12 times by now, 13 times by now, and it is the main principal source of indirect taxation in Sri Lanka at this moment. Another feature of our, the taxation regime, the revenue management in general, is that we have, the tax holidays and exemption regimes working in side by side with, the tax raising or revenue raising regimes, which we call, the dual taxation regimes. Tax exemptions were, very old, effective from 1951, put to practice in the Treasury until 1977. But dual taxation or the dual management of revenue or the exemption came after the GCEC Act of 1978, which was again, the made the BOI Act in 1992. The whole country was made, the BOI soon. Thereafter, in 2008, special development project act was brought in, which has a lot of powers to give, to do away with existing tariff regime to, allow for many tax holidays of very and exemptions of very deep nature. These are the major tax exemption holiday regimes in effect even as of now. So this is how we collect revenue at this moment. Tax to non-tax is something like, they varies over the years, but, in general, you can say that tax is 90% of total revenue, non-tax is 10%, which varies over the years, but in general, we can say 10% is non-tax revenue. Of the tax revenue, roughly about 55% is, the generated in the Inland Revenue Department, and 30% is generated in Customs Department. These numbers vary, depending on, the years of, the economic performance as well. Excise, the smallest, about 4%, and the remainder is from, the various other agencies. This is the revenue structure of 2019. I selected 29 because in 2020 and 2021, as said, have had, the many difficulties, the managing government revenue, I thought, the 2019 was, the somewhat better, for us to understand, the structure of our revenue in a normal year. Total revenue in 2019 was, was 12.6% of GDP, all in GDP, of which, the tax revenue was 11.6 and non-tax was just 1%. Of the total tax revenue, roughly about 25% came from income taxation. The goods and taxation brought about 56%, and the international trade tax, especially import taxation, brought in some 19%. Tax, the way there are many taxes, in force at the moment in the country, there are many varieties of tax. There's a complaint already, among the private sector entities, as well as, the policymakers, as well as the number of tax being implemented in force in Sri Lanka is too many. But however, we have, the major about 7 taxes, which brings in tax revenue of 11.6%, which brought in the 11.6% in 2019. Income tax is the one which comes to the second most important one in terms of the, the tax yield, 2.8% of GDP, and VAT was, 3%. NBT, the nation building tax, just 0.5%. Excise duties, which again an indirect tax, which has been in existence for a long time from 1911, 2.7%. Import duties, which has come down over the years, still, the figure high, 0.07. Port and airport development levy, again 0.7. Special commodity levy, 0.5. Others, 0.7. Put together comes to a tax revenue of 11.6% of GDP. This is just for you to understand how we are in managing, the country's revenue. This is what we see over the years, the trend. You see, they have taken, the World Bank data for comparative purpose. Even if you take, the numbers in rupees, the trend is the same. Our revenue to GDP has been going down from, I would say, from mid-1990s continuously, with no major changes over the years. This is what you see in this figure. 1993 was, the defining year where, when we change, certain taxes, indirect taxes. From there onward, we were not able to find, the better way of handling revenue from taxation. This is the level of per capita GDP against, the taxation revenue in percentage wise in across, the many countries, again, the taken from World Bank data. Ours is somewhere closer to, per capita is somewhere closer to 4,000. The revenues collection altogether, both direct and indirect tax collection, is just above, the 10%. This is 2018 data. But, if you look at comparator countries, the countries with comparable per capita GDP, we see, the Sri Lanka is on the bottom, except, Sri Lanka is on the bottom, and, normally the average for, this level of income, per capita income earners is something like, the 15 to 16%, that is the average. And also, as per capita income goes up, there is, the tendency for countries' revenue to go up. This is, what has been established in many research done in many places. This is what we see over the last, say, 3 decades or so. Tax to GDP, GDP in Sri Lanka was something like, the 14%, the average. The minimum was 10% in 2014. Maximum was 19% in 1990. That was the year beginning in this trend line. The maximum tax, the revenue, maximum taxation ratio was recorded in 1978 for the post-independent 74 years. 1978, 28.9%. Again, in global average for 160 countries, this is World Bank data, 17.5% in 2019. That is, the tax to GDP ratio for 116 countries. This is the irony. When Sri Lanka had been, the poorer, the country raised, the higher revenue, right? Until mid-1990s, if you look at the numbers, our revenue to GDP ratio has generally been, about 20%. When Sri Lanka became relatively rich, meaning when we became a middle-income country, the country raises, the relatively low revenue. It has been going down ever since, we became, it's at least for the last 2 decades, so it has been going down continuously. Sri Lanka revenue issues, of course, the revenue issues have been discussed from 1950s, but, if you look at the numbers, the revenue issues are of, the recent origin. Revenue issues are of, in my view, not more than 2 decades old. The lowest level of revenue were recorded in 2020 and 2021, 9.1% and 8.7% of GDP. This is the lowest revenue recorded in the last 74 years of, the post-independence history. Sri Lanka maintained a very high tax to GDP ratio over the decades since independence. Tax to GDP has been on the decline since mid-1990s. Of course, there are, the few years where we see, the certain reversals, but, I don't see any sustainability of, those measures, taken to raise revenue thereafter. But over the last nearly 3 decades, certainly 2 decades, Sri Lanka has not been able to, to fix this issue. They are struggling, to fix, to raise revenue to a respectable level. There are many reasons, we say, so many complaints about, the weakness in administration and revenue administration, tax policy issues, compliance issues. Those are being cited widely for the current state of, of revenue management in this country. Also, especially after 1978, and in particular mid-1990s, after the BOI was, created, the multitude tax exemptions, large number of discretionary tax, discretionary is allowed to under the under the laws themselves to various officers, discretionary power given to various officials in the tax administration. Those are some of the reasons cited in many places where, being the reason for, the very low, sometimes dismal performance in countries' revenue. This is the trend that we see when it comes to direct taxation, taxation from net income and profit. This has been going up, slowly over the last 3 decades or so. But its contribution remains in the region of 15 to 20% of total revenue of the country. Therefore, we have Sri Lanka has continued to depend heavily on indirect taxation for meeting government expenditure. At present, it is like 82%. This varies, usually we say 80-20. It varies over the years, but it hasn't gone beyond, I would say, the 20%, in general. This is the other trend that we see, the tax on international trade. Tax on international trade, especially tax on export, has been very easy, very simple thing that was abolished in 1993 after the Presidential Taxation Commission report, I guess. The tax on international trade is very easy, very simple, and also reliable, and also efficient in the sense that collection is very easy. Doesn't have to spend a lot of money to do, the collection work. Contribution of trade taxes to total revenue is in the region of 15 to 20% even at present. This is the, the sort of, the world benchmark, the norm. For low-income countries, it is 25%. But when it comes to lower middle-income countries, it's like 12%. Look at, the country's situation against the norm. And for upper middle-income countries, it is 9%. For high-income countries, it's 1% or less. In Sri Lanka's case, taxes imposed on imports account for over 20% of total tax revenue of the government, and it is significantly high for a lower middle-income country. This is the other trend that we see when it comes to taxes on goods and services. Over one half of total revenue comes from the tax on the goods and services, in particular VAT and excise. Weaknesses in direct taxation forces government to rely on indirect taxation. This has been a common complaint. This has been going on for a long time, which we were not able to fix it yet. These are some of the issues that we see needs to be confronted with, needs to be resolved. In general, as I said, the tax share as a percentage of gross domestic product is expected to increase when per capita income rises. This is the norm, that we see in many countries. If you look at experience of many countries across Asia and many countries in the world. In Sri Lanka, we saw this same trend for about 3 decades or so. We somehow, maintain a revenue to GDP ratio of about over 20% until early 1990s. But our per capita income continued to grow even after that. But we see, the last 25, 30 years or so, countries' per capita income has been rising, but tax to GDP ratio, the revenue to GDP ratio has been falling. We could not even maintain the ratio that we have inherited from the past. It has been falling while the per capita income has been rising, suggesting, the sort of an inverse relationship between the revenue to GDP against per capita income. This is something that we need to, somehow, the undo. But in the past, we have had, a positive relationship for about 30 years or so. But for some reason, while per capita income was rising, we were not able to even to maintain the past trend, but we see, the reverse in the trend. While per capita income was rising, the revenue to GDP ratio has been falling. This is one major issue that I see. Second one is it's a complaint, the complaint by the academia, as well as, the private sector, establishment, the over-dependence on indirect taxation for revenue. This has been a major anomaly with 4 presidential taxation commissions. Many, there has been, several other trade-related trade and tariff reform commissions as well, and also independent consultancy work for the Treasury. With all that, for the last 75 years or so, 74 years or so, we were not able to, to get the indirect taxation to a respectable level in this country. I saw when first, the income tax law was passed in 1932, the income tax, the direct taxation was something like those, it was an estimate, something like 15% of the GDP at that time. We have not been able to, do much beyond what has been recorded about, the 80, 90 years ago. This is the second issue that I see. Third one is over-dependence on international trade taxes on imports. We abolished trade taxes in 1993. Thereafter, we start taxing imports heavily to manage government revenue or meeting the government expenditure. This is again an over-dependence in the sense that, for comparator countries, it's like something like 12%, ours is like, to 20%. Many trade economists have, has shown and also written so many things about, the over-dependent on trade taxes. In fact, this should have been brought down along with the trade liberalization, the trade policy liberalization work undertaken since 1978. It has gone down for some time, but probably with the intensification of the internal war, government has not been able to find the respectable revenue from other sources. Therefore, the government had to stick to international trade taxation on international trade, which was the easy, very simple and very quick. That could have been the reason. But this is one area where we see a major structural anomaly in Sri Lanka's tax structure. Again, from our own experience in the past, and also from the comparative income countries of comparative income levels. This is the anomaly. The international trend suggests that the share of taxes on imports as a percentage of total revenue falls with the rising income levels. This is one thing that one thing that we see, internationally of similar income level countries, and also from the experience from the past as well. This is the other issue that I see, that brought before you. We see, the declining government revenue over the last 25, 30 years. Government has been trying, very hard, the intermittent to reverse this one. We were not able to fix it anyway. But we have another issue at this moment. Even if you want to, the reverse it, the going back into, say, 2019 level of revenue measures, income taxation and VAT, we have another issue that we have, to confront today. How to achieve, the higher level of revenue. Revenue is below 10% of GDP at this moment, for the last 2 years or so. How to achieve higher level of revenue in the midst of, the economic crisis is a key problem. but without revenue, you cannot run a bigger government. And varieties of subsidies and lot of other expenditure as well. And raising revenue to a higher level, at least at least to the level of 20% of GDP is a very difficult task, particularly in the crisis context faced by the country. The other issue that has been, the flag from 1960s is, the high degree of fragmentation among key revenue agencies. The revenue agencies are, they're quite old. The custom has been in existence from, the early 19th century. Then the income tax department, income tax work has been, in existence from 1930s. Excise has been in existence from 1911. There are other agencies which gives us, the bit of revenue as well of recent origin. But there is no coordination between, the proper coordination between these revenue agencies. This was highlighted in mid-1960s Revenue Inquiry Commission as well, to put, the revenue agencies under one umbrella, which for the last 50 years, we have not been able to do any significant positive action to, bring them into one umbrella. Say, for example, Telecom Regulatory Authority, that also brings about, the handsome amount of revenue to the country, but it lies somewhere else outside the purview of the General Treasury. Excise, customs, and inland revenue has always been under the Treasury, but they work under the separate pieces of legislation which are very old, of course, updated from time to time, but still the work independently. Say, for example, if you have to coordinate for the collection of VAT on imports, we need to somehow solicit support from the Sri Lanka Customs, and also for certain excisable items, imported excisable items, Excise Department has to solicit support from the Sri Lanka Customs. Legally, they are separated, work independently, enforce tax laws separately. Of course, although they are under the Treasury, still, the fragmentation exists. Coordination has become seriously difficult. That cost, in the sense that, the revenue management, if you are to raise, the larger amount of revenue to, the revenue to a respectable level, like, the 20% or, the above 15%, some coordination at various levels, the organization level, law, and also the operational level. Coordination between revenue agencies has to be there. Therefore, the Revenue Commission, the Taxation Commission suggested, the revenue boards, separate revenue organization, which government was unable to put into implementation for various reasons over the years. These are the thoughts that I have at the moment to, to share with you all. I will stop at this stage, allow Professor to, continue with the second presentation. Thank you very much.
Thank you, Dr. Samarthunga. You outlined the major problems regarding taxation in the country. And in fact, those issues, as you categorically mentioned, that there has been a lot of discussions and debates in the country over the last couple of decades. And however, we didn't have to wait until we learn it from a hard knock. And now we have learned it from a hard knock, so that the reforms have to, it's going to be very painful rather than gradual process. Now it is necessary to take these reforms forward. Now, some of the important things that caught my attention was, in spite of declining tax revenue as a percentage of GDP, our direct tax revenue, the change in the direct tax revenue has been a very remarkable thing. It has been, as you rightly pointed out, I think about 15 to 20% of total tax revenue. Only 15 to 20% comes from direct tax revenue. In fact, unless it has been a policy that we have adopted, it should be somewhere around 40 to 50%, to my understanding, according to our present income levels. So the major problem has been that the government does not know the country's citizens' wealth and income, or doesn't want to know wealth and income, so that when the government doesn't know wealth and income of each and every individual, the government has to depend automatically on indirect tax revenue, and indirect tax revenue has been a very complicated issue on the other hand. Although we rhetorically said that Sri Lanka is an open economy, and your data also indicate that Sri Lanka is no more an open economy, because when you look at the taxes on international trade, it is very clear that, and in fact, I have also seen this in World Bank data also, our neighboring countries, most of our neighboring countries, including India, they have comparatively, they have very low taxes on international trade as a percentage of total tax revenue. Whereas in Sri Lanka, it is according to your data, 19% of tax revenue comes from international trade taxes. Whereas in India, as I remember, in 2019, it was 4.5%. So it clearly shows that we have been sliding down even in terms of our market economy policy reform. So we had to wait until we learn it from a hard knock. That is the sad part of the story. So anyway, thank you so much for highlighting all these major issues. In fact, they show where the reforms should come from. It's not simply changing tax rates and finding the ways and means to impose some other taxes. It is complete overhaul, a reform process that is needed to support the recovery process. So with that note, let me invite Murtaza. He's going to talk about the private sector perspective regarding optimal taxation in Sri Lanka. Murtaza, over to you.
Thank you, Professor Abhiratna. Good evening, everyone. My name is Murtaza Jafferji, and you might be wondering what I'm doing here. My day job is actually basically as in the investment field in the stock market. I'm also quite passionate about policy issues. So I am the chairman of a public policy think tank at Jakarta. And I'm not a PhD economist. There's many professors and doctors on this call. And you might be wondering, what credence do I have to address you today? Well, most of my knowledge is pretty much self-taught. But this is a deep problem that I feel quite closely, because the dysfunctionality in our economy and our society is fundamentally because of a dysfunctional tax system. And Professor Mick Moore, who has done a lot of work in Sri Lanka, he has commented that societies in which citizens pay taxes enjoy better governance. And one of the governance deficits in our country is because our society does not pay taxes. There, as he says, you need a social compact, that the citizens must feel that if they pay taxes, basically they will get governance and accountability from their rulers, which unfortunately in Sri Lanka does not exist. And therefore there is a reluctance to pay taxes. So some of the slides that I have prepared, I'm going to speed it up because they are overlapping on what Dr. Samaratunga spoke about. But my slides are more visual analysis of some of the facts and figures that he spoke about. So there are some trends, etc., that may interest you. And I will have my slides available. Because I felt so deeply about this issue, last year, just let me, I basically spent some time doing a virtual course from the Harvard Kennedy School, which they normally do it over 2 weeks, that you have to go to Boston, called Comparative Tax Policy. And I've been kind of foreseeing this crisis from about 7 years ago. And I've been trying to kind of nudge policymakers from 2015 to please send more people in from Sri Lanka to this course for us to get better appraised on various tax policies and administrations around the world, so that we can strengthen it. But except for one person, when Governor Kumaraswamy was the governor who went from the central bank, I'm afraid that I was not successful in sending anybody, including the last ST, before the current ST. So let me pivot to my presentation today. It's called Optimal Tax System for Economic Development in Sri Lanka from a Private Sector Perspective. Let me start with a few basics. Why do we tax? Taxes introduce deadweight losses, the economists here, on society. So any tax impacts economic efficiency. Indirect taxes impact either the producer or consumer welfare. And direct taxes reduce disposable income of earners. So this is the basic graph of what a deadweight loss happens, that if you have a direct tax, basically the income reduces. So if the disposable income reduces, you have less money either to spend or to save. And in the case of indirect taxes, basically, depending on the elasticity of the product, that either basically the consumer bears the burden or the producer bears the burden, but invariably the total output does come down because higher prices make it more expensive, therefore affordability is impacted, and therefore consumption comes down. So ideally, you would not want taxation and have a complete free market. But the problem is that the market economy, and some notable quotes, taxes are what we pay for a civilized society. In some respects, a civilized society is the rationale for governments in the first place. This basically is written in the US Inland Revenue Service, that when you enter on the top, this is what is written. And this is Professor Mick Moore, societies in which its citizens pay taxes enjoy better governance. So we need government, and you need taxes because you need to pay for government. In a market economy, it cannot function without the rule of law, regulation, infrastructure, security, and defense. You need public goods. The definition is those that are non-rival and non-excludable. Not all goods that are provided by government are public goods. Example is education and healthcare. So it is that somebody has to pay for it. So in terms of redistribution spending, that you want to give everybody equal opportunity, and therefore not everybody has the endowment to pay for these things. So you need a system where everybody is taken along. And that is the essence of the social market economy. The current Prime Minister basically started speaking about the social market economy in 2015. And it was the German system. The economic miracle happened because of the German system. And I did read a lot of books about the benefits of the social market economy. So basically, the thinking behind it is that you allow business to operate on market principles. You allow the free market to thrive, but nobody is left behind. And that is why you need government to ensure that the market rules are obeyed, and that you only intervene when there is market failure. And there is some element of redistribution, a basic income for those who really are below the safety net, and for others that some access to quality education and healthcare, so that everybody has equal opportunity in life, not necessarily equal results. So the concept of a run curve, this is specifically for the US, what it shows you is that there is an optimal point of government spending, that government spending obviously focused on certain types of infrastructure, public goods, certain kind of economics, system will ensure that the economy will grow faster because it reduces market failure, it is fairness, dispute resolution. But above a certain level of government spending, it becomes an inhibitor to growth. And then in terms of taxation, you have the famous Laffer Curve, which basically is a theoretical concept. It's highly criticized. Not everybody agrees with it, but it's a conceptual concept that there is an optimal revenue maximizing point but the growth maximizing point is a lot lower. So the question is that how do you optimize all these different variables? And these are theoretical concepts. I mean, for all different economies, it's all very different, but there has to be a scientific approach, and that's where economists come in. How to basically adjust your economy, basically that, you know, the needs for the government are balanced out with the needs of the citizens, and how do you grow your country? So there are some immutable truisms about taxation. If you tax something, you will have less of it. If you subsidize something, you will have more of it. Corrective taxes are used to correct for negative externalities, and tax subsidies are used to incentivize positive externalities. All indirect taxes are not regressive. There is a misconception that, you know, all indirect taxes are regressive. I mean, it's a general statement. So for example, in Sri Lanka, the taxes on mobile phones are only 5%. There's a PAL of 5%. Now, I don't think if you say that, you know, you are going to put V80 on mobile phones. I mean, people who buy iPhones, which is above $1,000 at today's exchange rate, 350,000 rupees. I mean, non-rich people are only going to be able to afford iPhones, not poor people. So there are some tax definitions here. I will leave it in the slides for those who are interested in my slides. And just want to show, because there's a complete misconception about how economies grow. There are two fundamental things. Either you employ more people or you increase the output per person. And the output per person can either be increased by increasing the capital intensity. For example, you give a farmer tractor, or you increase the total factor productivity. Now, this is by far the most operative word that we should use in our lexicon in Sri Lanka. Very few people, very few politicians, very few academics, I hear them talking extensively about TFP. But on every citizen of Sri Lanka, I believe that we have to teach them what TFP is, because in future, basically, factor accumulation, borrowing overseas, borrowing money, and creating government jobs, etc., cannot drive our economy, but it is TFP, which comes from investment in human resources, technical progress, and economic restructuring that has to drive it. Why am I talking about all this? So I will try to link it up about taxation. And in 2017-18, the Center for International Development basically did an analysis in Sri Lanka of what's holding back investment. This was used to come up with the Millennium Challenge Corporation, which finally that they agreed to grant us $480 million, but for some unknown reason, our president and certain advisors decided not to go ahead with it. The reason that I put this slide up here is, if you focus on the maroon ones, that when the question was asked from investors, what are your binding constraints? Nobody said it's a tax, right? Nobody said it was the tax system. So the question is, if nobody said it is a tax system, why did we cut the taxes towards the end of 2019? I can tell you as a businessman, my binding constraints, the biggest binding constraint that I have is land. This is in my renewable energy industry. Land is a huge problem because 84% of the land is owned by the government. Let's see how income is distributed in our economy. This is a very interesting slide, which is there on the last page of the appendix table of the Central Bank annual report. This comes from the socioeconomic survey. And look how income is distributed in Sri Lanka. Look at the 2019 thing. The bottom decile has 2%. The top decile basically has 36%. The top 20% of households account for 51% of income. So if we are going to have a sustainable tax system, and we need to increase tax to GDP from the very low of less than 8% last year to perhaps even we are talking about a primary balance surplus of 2%, which means that we'll have to lift it to about 16% of GDP, almost double it in 3 years. It is this 51%, and more specifically the 36% in a progressive tax system, who should be paying the taxes, basically. So these are the people that we need to go after. Now, invariably, these people are the most connected. They are the people who fund politicians. They are the ones with vested interests. They are the people with extractive industries or rent seeking. So this is the issue of the political economy, and this is going to be a tough challenge. The challenge is not the tax policy. I mean, you don't need, Sam will be able to say you need 3 people in the room to decide how to tax the economy. You know, it's not rocket science. It's the issues of the political economy that is very difficult to overcome. So let's look at our fiscal performance. These are some of the things that Sam spoke about, but I will show it to you in a graphical way. This is over a period of 20 years. What happened to revenue? Now, the concept of primary expenditure is not in the lexicon of most economists, but it is basically government expenditure without interest. Why is primary expenditure important? Because basically, if you evaluate a finance minister and his budget, interest is on debt that he accumulated. But primary expenditure is what he controls from the revenue that he collects in any 1 year. So how you should evaluate a particular budget is to look whether the particular finance minister is able to target a primary balance surplus or a deficit. And I've shown the primary balance deficit over a number of years here. And you can see that except for 2 years in 2017 and 18, which were small surpluses, and the last time was 1956 and 1957, or was it 55 and 56, we have continuously been running primary balance deficits. This is the same thing over a much longer period of time. And you can see that, you know, in many decades ago, there were very, very large primary balance deficits that were run. Thereafter, the primary balance deficits did come down, but the interest, I mean, the debt started accumulating. By about the 1980s, we were carrying a high amount of debt. I mean, our debt to GDP for many years have been running in the 70, 80, 90%. Even pre-war, we were close to 100%, but most of it was domestic debt, which got inflated away. And then, of course, the economy grew post-conflict. And that's one way we were able to bring it down. But we've been running primary balance deficits for a very long time. Now, the key issue is here. And this is another graph which is indexed at 100. And it shows you nominal GDP. And you can see that the tax revenue is significantly lagging, right? This is an index starting on year 2100. So there is something not right here where your economy is growing. Basically, your expenditure is probably going at a faster rate, but your tax revenue is simply not keeping up. So either basically there is parts of the economy that are growing, which you are not sufficiently taxing, or basically all the areas of the economy, you are reducing your tax burden. So this is our tax collection in absolute terms shown over a period of time. Now, generally what happens is that, you know, this does not happen in absolute terms. You know, you might have relative terms that the tax to GDP may come down, but here is a classic example that in terms of absolute terms, that the tax cuts that happened in 2019, this had a significant reduction. And this is a bit of a rounding out, and this is total revenue. So you look at the tax revenue basically, and this is where this so-called 600 billion figure comes from. I think the real figure is a little bit below 600 billion, but this is a graphical explanation of how the revenue came down. Now, of course, the revenue has a significant impact. It is not only tax policy, but it's also tax buoyancy. So if your economy is growing fast, then the ability to collect taxes are higher because companies make bigger profits. People spend discretionary items, which have higher amount of tax intensity. You know, personal income tax is higher because people get bonuses, variable income, which is taxed. Okay, so this shows you again the same graph over a long period of time, and this is comparatively is not realistic because, you know, the nominal figures because of high GDP, but it kind of shows you that, you know, that there was an increase in nominal terms in revenue and then it came down, but as a percentage of GDP it has been coming down. Now, if we compare ourselves to peers, we are significantly down. Even a country like Bangladesh, basically, which had a relatively poor population, our tax to GDP and our per capita income used to be double that of Bangladesh. But with the recent depreciation in the currency, I'm presuming that in a few years they will beat us because their economy is growing at about 7%. As you can see here, that ours is very low. And if you compare with even regional peers, they're significantly higher than us. And some of these countries have per capita incomes lower than us. So this is from Professor Mick Moore, and he shows the composition of taxation between, say, pre-independence, pre-World War II, and something maybe a few years ago when he published it. I mean, there has always been a reliance in Sri Lanka on tax on imports. So taxing imports is not generally a new phenomenon. It has been a simple part, trade taxes, because we used to tax exports. They have a commodity exporting, and that's how the colonial administration raised taxes. And this is an interesting a factor that you can think about later. So the indirect taxation that Sam talked about, 76%, we got 76% total tax revenue is coming from indirect taxation. And this is how the composition of those indirect taxes are. Income-based taxation is quite low. So why is there an excessive reliance on indirect taxation? And indirect taxes are mainly collected through customs and excise. Changes to direct taxes require amendments to legislation. The tax effort is greater in direct taxation. There is more moving parts in computing the assessable income, which requires more effort and skill. And the bulk of indirect taxes are collected from 4 items: cigarettes, liquor, petroleum, and vehicles. And I looked at, something that I looked at, comparative tax policy program. One of the things, Professor Lawrence Summers, he had done an analysis in the US, and this is a highly, controversial issue. What he says, the Republicans cut funding of the Inland Revenue Service. So they did it purposely so that, the Inland Revenue Service was not funded well, so the ability to collect taxes. And he wrote a paper basically to show that if you basically double the allocation to the Inland Revenue Service within the existing tax policy, that there can be a significant increase in basically tax collection. Now, Sam has been a former Treasury Secretary. So one of the questions I'd like to ask him thereafter is how the Treasury looked at funding the Inland Revenue Service, basically. Did they look to increase the funding? Because when I looked at the collection effort and I looked at how much was being spent in collecting taxes, basically, I mean, the tax overhead is less than 1% of the taxes collected. So the question is that if we increase it to 2%, can we collect a hell of a lot more taxes? Mm-hmm. And these are the key institutions that collect the taxes. Basically, you have the customs, inland revenue, and excise. And I have put in some interesting facts and figures that people who want my slides can go through. And there, where my cursor is, tax expenditure as a percentage of department revenue. So the customs, it's custom 0.4, inland revenue 0.85, and excise 0.95. That's an interesting expenditure ratio. One of my analysts updated this. This may be a couple of years old because the data, there's a lag. We can only work with publicly available data. So the composition of import taxes, this is where the import taxes come. And you can see that in 2020, partly because of the V80 reduction, but partly because we curtailed imports, including vehicles, there was a big drop in this thing. So one of our problems is that what we do is what I call bandage economics. We have a problem. I mean, most economists here understand about general equilibrium. That is like the human body. Every part is interconnected. I mean, if you have a diseased limb, basically, if you don't treat it, it will come and infect the rest of your body. But that's not the approach that we take in managing our economy. We just think that everything is siloed, basically. So we start meddling in one side, and then it starts distorting another side, and then to counterbalance that, you go and adjust somewhere else, and one big mess. I mean, I wish there is somebody basically who takes a clean sheet of paper, and I believe that the Prime Minister is basically going to come up with a new budget, and Sam is very much there in the driving seat. So you are going to take a fresh piece of paper and try to fix this once and for all, basically, where all these distortions basically can be reduced significantly. So this is the domestic taxes. Again, it's the V80 that comes in. And these are the income-based taxes. Most of it, you can see, is collected from the corporates. And I stand to be corrected, more than 50% of the corporate tax comes from the financial sector. Now, our financial sector is in serious distress. It is in serious distress, basically. So no longer can we use the spigot of trying to tax the banks, to tax the finance companies, etc., to raise these corporate taxes, because now with this kind of sovereign default and them holding so many of these instruments, we cannot overtax that sector, because we will have to allow regulatory forbearance and internal accruals for them to rebuild their capital base. Some items we tax very high. Some items we tax very low. And these are some facts and figures I would like to share with you about basically where we collect taxes. Again, I'm using old data because I don't have the most recent fuel. Most countries collect a lot of taxes from fuel. But in the year 2019, because we played politics with fuel for such a long time, as a percentage of the total selling revenue, only 25% is collected as taxes from fuel. In tobacco, it's a very high tax incentive, 84%. Alcohol, 80% of the sales value. Vehicles, 35%. And remember, in 2020, we banned vehicles. 2021 is one of the largest sources of tax revenue. You can look that in the years 2017, 2018, we're collecting over 200 billion rupees from vehicle taxes. And then in the banking sector, we were collecting slightly lower at about 173 billion. So look at the tax policy. This is a graph that shows all the tax changes that were done. And this is a slide that illustrates what happened to the VAT. You can see that this is over a period of 20 years. Look at the changes that we are doing to the VAT system. The bottom here is the VAT threshold. So the previous threshold that we had was 12 million rupees. We took it to 300 million rupees. And that as a percentage of revenue, the total revenue used to be about 22%, and that has now dropped in 2020 to less than 20, and it slightly went up. The VAT rate was reduced from 15, and the threshold went from 12 to this. Now, this is a slide I had from my tax program from IMF paper, and it shows how much VAT is collected as a percentage of GDP. We used to be upper middle income and we came down to lower middle income. In most countries, they are collecting something like 6% of GDP. In Sri Lanka, we are collecting about 1.5% of GDP from VAT. Now, it's a bit distorting in Sri Lanka because we go and put excise taxes on certain things and then remove VAT. So, you know, in lieu of VAT, we put excise taxes and it's a bit confusing. But one thing is for sure, that you can collect a lot of taxes. The heavy lifting has to come from the VAT. And the VAT is the least distortionary form of taxes. Then you look at corporate taxes. Even a lower middle income country can collect close to 3% of GDP from corporate taxes. We don't collect anywhere near that. And personal income tax, of course, is a challenge in a middle income, lower middle income country like that. It's not a lot. We must make sure that at least the rich, the top 10% pay their fair share. And this is an example that I did of two businesses, one with a turnover of 50 million and one with a turnover of 100 million over a period of time. And what it is showing is that, you know, and this is growing with the economy, and you can see that how the tax rate is coming down over a period of time. This is an analysis to show fuel taxes. And you can see that because although we recently are now having cost recovery of fuel, yet on petrol, our total tax from the selling price is only 14%, one of the lowest tax rates in the world. And on diesel, it's only 6%. Again, extremely low. And from a historical perspective also, fuel is massively undertaxed. This is an item that deserves corrective taxes. And World Bank has shown that, you know, it's the top 30% of households that benefit from 70% of the fuel subsidy that was implemented. And I call it a subsidy because it is being taxed at a rate lower than how you are taxing all other items in the economy. This again is an example of personal income taxes, and this shows you scenario of people starting with 1.2 million in 2000, another person starting with an income of 100,000 a month, 200,000, and what his tax burden is. And you can see in this, when you look at this thing, that in most cases, over 22 years, although his income is growing with GDP, his tax burden basically is coming down, basically. And this is an interesting chart. This is before the depreciation. I was unable to update it thereafter. That our tax free threshold of 3 million rupees at the old exchange rate of 200 was higher than Singapore and Australia. whose per capita income is probably 8 to 10 times more than Sri Lanka. Okay, so our tax-free threshold is 4 times our per capita income. While in those countries, basically the tax-free threshold is at 20% of per capita income. These are some facts and figures about taxpayers. In 2019, there was 1.5 million taxpayers. In 2020, there was 1 million. And I heard in a recent speech when the finance minister Ali Sabri was asked by the opposition leader, I think he gave a figure of 500,000 taxpayers. I think he was saying in Sinhalese. I think I got that figure correct. So what is the art of taxation? As Jean-Baptiste Colbert, who was Louis XIV's finance minister, said, the art of taxation consists in plucking the goose as to obtain the largest possible amount of feathers with the smallest possible amount of hissing. So, wrong way to do tax subsidies. Now, we have been giving tax holidays to everybody, and this has shown that in terms of tax incentives, basically, it is not the main criteria in promoting investment. Right? If you want to attract FDI, etc., economic stability, political stability, cost of raw materials, local market taxes, these factors are far, far more important than incentive packages. Now, you take a simple NPV framework. I do realize I'm running behind a bit of time. I will speed up. You take a simple NPV framework. I am an investor. I have invested in many projects in basically renewable energy, in so many different projects. I want to improve my NPV. What do I want to do? First of all, I want to reduce the uncertainty of my cash flows. I want to increase the magnitude of my cash inflows. And I would like the magnitude to be sooner, the cash inflows to be sooner. I would like to reduce the magnitude of my cash outflows and to delay my cash flows as much as possible. Those are the things that improve my NPV, right? Now, tax only is payable once you are successful, right? You only pay taxes when you are successful. Now, as far as an investor is concerned, all the factors that allow me to change the magnitude and the timing of these cash flows have nothing, very little to do with taxation. So help me improve those things. Like, for example, in my renewable energy project, access to land, clearance, the 16 approvals that needed. Those things, if I can speed it up, my returns will improve. And therefore, I'm willing to pay my 24% taxes. I don't have a problem because I'm going to generate cash flows much sooner. Now, these are projects that have been given tax holidays. Now, the question is, these are not tradable sectors. These are not sectors with positive externalities. These are not sectors that create massive amount of employment. What is the merit of us giving massive tax holidays, 15 years, 20 years? Basically, I do not understand why we did it. Basically, these are the issues of the political economy, and I don't know whether there was some element of corruption involved. For example, take port services. There was a West terminal that was recently given. It was said that for geopolitical reasons, we have to give it to India, but it was given to a private businessman who is today one of the richest people in India. No competitive bidding, nothing. On a plate, it was given. And there is an act out. I believe the tax holiday, it was said, whatever the Chinese got, the Indians got, which is about a 15-year tax holiday. What is the merit? Your port is located at the southern tip of the Indian Ocean. All the ships are coming, basically. You have huge geographical advantage. Where is the merit of giving tax holidays? Now, take this, an example. This is in the previous thing. If you construct a building, you pay 14% tax. But if you manufacture an item that goes into a building, you pay 18% tax. What is the logic of that? Basically. And for example, you can say like a case for a tax subsidy like a hotel. A hotel is a low return business because you are sitting on an asset that lasts for a very long time. And there is so much of uncertainty, from the political environment, bombs going, this, that. It's a low return, but you need a hotel to attract tourists. And the tourist spend outside the hotel is significantly greater than the tourist spend within the hotel, basically. So in impoverished areas, in certain cases, there is a case on a case-by-case basis to think about tax incentives, basically. Microsoft and Google pay 21% tax. In Sri Lanka, the entire sector is exempted. And this is one of the fastest growing sectors in Sri Lanka. What is the merit in that? One pays income taxes only after one becomes profitable. Sharing one's success is a price we must pay to have a civilized society. The onus on why did I go into all these details and exceed even my time listings? Because I wanted to explain what is wrong with the system and how to fix it in a fair system. The onus on budgeting is on spending. Revenue is a balancing item. This is something that I learned from Sam. Basically, they decide how to spend and then they figure out how to find the money to pay for the expenditure. I don't think tax policy is done on a scientific basis. Our current tax policy creates winners and losers. It's not fair. The top 10% of households account for 36% of income. Sorry, it shouldn't be taxes. Some rich people pay their fair share of taxes, but many don't. What can we tax? What one buys, what one earns, what one owns. These are the three things. What one buys, what one earns, what one owns. Few taxes. So what are the elements of a good tax policy? Few taxes, VAT and income taxes should be the mainstream. Indirect taxes, VAT should get us close to 6% of GDP. Currently, it is 1.5%. Excise taxes should be applied as corrective taxes. Property taxes should be introduced. Reduce reliance on border taxes. Have perhaps two bands of duty, 10 and 20%. Do away with PAL and cess, which are para tariffs and extremely protective in nature. Personal income taxes should only have 3 bands. Reduce the tax-free threshold to 1.8 million from 3 million, which means above an income of 150,000 rupees a month. The headline rate of tax should be 18%. There is some move to try to increase it. I fall into that bracket. I'm disclosing my interest. But I feel they shouldn't take it up for the simple reason that the inflation tax is so high that wealth is getting destroyed. Withholding taxes are a good idea. It should not be the final tax. Corporate taxes should be progressive, 14% for the first 50 million and then 24%. Now we have a thing called SMEs. And we define it from a band of 500 million. But the unfair thing is, if you do a trading business, 500 million, and you do a service business, 500 million are two different thresholds. So what we should do is, like personal income tax, we should have a progressive thing. The first 50 million of corporate tax, you will pay 14%, and thereafter you are going to pay 24% for everybody. Tax credits are a good idea, not tax holidays. You give tax credit. If you train a person, because that person can leave and there is market failure, so you can't hold the person back if he wants to leave. But as long as he remains in Sri Lanka, from that trading, he will earn high income, and therefore you can get him somewhere in the system. Offer tax credits. So if you train a person, certified 100,000 rupees, you can offset against your taxes. Taxing dividend is a bad idea. It's a double tax. It applies to only companies, not proprietorships and partnerships. So for example, if you invest in a company that pays 24% tax, the dividend in your hand is part of your assessable income and it will get taxed at 18. So you look at the cascading effects, you'll end up with a tax burden of 40%. Dividends is the return for risk capital. We should correct this with the Australian system of franking credits. Preferential tax rate should be applicable on source of income, not the type of taxpayer. And finally, broaden the tax base. It should be one rate. The threshold should be based on value addition, not revenue. And finally, I will show you an example of tax policy, good tax policy that was controversial. This is the kind of revenue raised on cigarette taxes. This is what happened to cigarette sales over a period of time. We used to do about 3.1 billion sticks. It has come down to about 2.3 billion because of very high taxation, right? The price of a cigarette has gone up significantly. Now, this was tried at the last budget, basically. There is a cigarette called Capstan. It's a cigarette that they try to attack the BD market, from which the collection is quite small. Capstan cigarette was about 20 rupees. They reduced the price for 10 rupees. right? There was a lot of criticism. So the government used to collect 13 rupees 50 from a capstan. They cut it to 6 rupees 75, but the price of the capstan also came down. Now, in the previous pre-budget quarter, the sales of capstan used to be about 60 million sticks. Now it has gone up to 100 million sticks. So it is still revenue negative. But the problem is that on a capstan, basically the retail margin is only about 39 cents before, and now it's down to 19 cents, 19 Sri Lankan cents. While on a basically a John Player gold leaf, which costs about 70 rupees, they get a retail margin of about 2 rupees. And since it's a dark industry, you can't even advertise and say that, you know, capstan is only 10 rupees, smoke it instead of BD. But because of the issue with the retail margin, basically there's no incentive to push it. So I wanted to leave you with this one case that this is right kind of government policy. It should be adjusted to allow the retailer to have a margin of about, say, 50 cents or 1 rupee, so that they push it, so that you have, okay, smoking is all bad, but it's better to smoke capstan than BD. So on that note, I have taken longer than I was allotted. My apologies. I had a few things to say. I will end my presentation and I will make it available to anybody who wants it.
Thank you, Mr. Jafferji. You took us to very detailed micro-level analysis, and so that I can understand the non-scientific and ad hoc base of all these taxes, direct taxes as well as indirect taxes. That's an eye-opener. So we have a macroeconomic perspective on taxation by Dr. Samarthung, as well as the microeconomic analysis by Mr. Jafferji. So now the floor is open for questions, and there are a couple of questions in the chat box as well. There is one hand raised here. Let me see. Well, the first one is actually a simple question, though it looks complicated right this moment. And how do we raise tax revenue in absolute terms? I think the channel is talking about how do we raise tax revenue in a situation where we are faced with an economic crisis. Before that, I can also ask from the audience. I talked to Professor Pemachandra Atukorla joining from Australia, ANU. Professor Atukorla, you like to make any comments?
Yeah, Sirmal, I enjoyed both presentations. Excellent. I have three comments, yes. But you can cut me off if I'll be quick, right? The first comment relates to the interesting point made by Dr. Samarthung about the U-shaped nature of our tax to GDP ratio. When income levels were lower, tax rate was increasing, but particularly after we achieved middle income status, tax rate has declined. This is a very important point. However, when you look at the 1950s and 60s, we have to be a bit careful. Sri Lanka was taxing our dynamic export industries. That's why tax to GDP ratio was very high during that period. Say, countries like Malaysia promoted their primary industries, shifting from rubber to palm oil and so on. They had a very low tax rate, export tax rate during that period. Therefore, we should not try to get lessons from that 50s and 60s. But Dr. Samarthung made one very important point. When income tax was tax act was introduced in 1932, income tax to GDP ratio was around 30%. And that declined continuously during the post-independence period. I think that point, when combined with Dr. Samarthung's interesting comment relating to achieving high income level and their tax rate decline, these two taken together have very important points. The basic point is that we are still relying on indirect taxes. Income tax rate has been plummeting throughout the period. In the 30s, it was 30%, right? Therefore, when we learn lesson from history, we have to look at these figures carefully. The second point relates to trade taxes. It is true that even during the colonial period, trade tax was very high. But don't forget the fact that in the 50s and 60s, income tax import tax rate was very low, close to zero. The high rate came from export duties, right? And then our problem after liberalization of the economy is that the so-called trade opening has not gone together with reducing our taxes, import taxes. Now, this point is very important. One of the main reasons why it succumbed to the balance of payment crisis was that our debt overhang was increasing, but our export to GDP ratio had been declining continuously. In other words, there was a built-in anti-tradable bias evolved in the economy from the mid-2000s, right? Therefore, there has to be a restructuring or reform in the import duties. It is not only level of import duty, but the cascading nature of the tariff structure, right? It is a gold mine for corrupt tax officers, right? You have got many tax rates irrationally implemented, and therefore it is easy for tax officers to shift one commodity from one to another and make profit. I have been studying the Chilean example. Chile is a country which started with a hugely cascading tariff structure. During IND time, tariffs were ranging from 3% to 200%, right? Then Chile brought the tax import duties to a uniform 5% level. And Victorio Cobo, former central bank governor in Chile, has written about it, including a paper in American Economic Review. When tariff levels decline, you won't believe tax revenue increased. It is easy to increase revenue, high revenue, when you have a more uniform tax system. And the second point is that tax administration efficiency increased fivefold, simply because in a cascading import duty structure, a lot of manipulation and the delay in approvals and so on. Therefore, not only our import duty levels are very high, but it is a cascading import duty structure, irrational system. Dr. Musa came up with some example relating to that. Therefore, basic anomaly here is not export duties. Reducing export duties, abolishing export duties in 1993 was a very good move. But we need to restructure the tariff structure. The third point is relating to incentive, tax incentive. Mr. Jaffery came up with very nice examples with the incentives are highly distorted. I fully agree with this. Actually, one mistake done even Mick Moore's interesting paper is that he does not make a distinction between export-oriented foreign direct investment and domestic-oriented activities which Ms. Jaffery was talking about. Now, this is something I have learned by studying the system in Vietnam, Malaysia, Thailand, and various other countries. When it comes to export-oriented foreign direct investment, we can't give away abolish incentives. Actually, when it comes to winning investment tournament, tax incentives become very important. I mean, if you want to bring big investors to the country, we can't ignore incentives. One important point is that incentives have to be time bound, right? Then here, when incentives are given, it becomes a perennial thing. That is wrong. But time-bound incentives are needed when it comes to export-oriented investment. Actually, there we are talking about income that we never earn if the investor does not come to the country. I know how Vietnam attracted Samsung to come and set up a production base there. Why Intel went there? In both cases, incentives were very important. Therefore, I fully agree with Mr. Jaffarji. Our incentive, tax incentive structure is highly distorted, but one should not forget about the role of incentives when it comes to winning an investment tournament. Again, there's a qualification. We need time-bound incentive. Mick Moore has entirely ignored that important point in this study. Finally, I have a question. Now, Mr. Jaffarji said that government is the biggest landowner in Sri Lanka, wealth owner as well as landowner. Is there any room for the type of land banks or land board system under which government can improve its assets and earn revenue from that? Singapore did not have income tax during the early stage. Their main revenue source was land rent coming from their land ownership. And Penang, I have done a study there, a land bank turned out to be the major income source of the government. Therefore, government didn't have to go for income tax and other disincentive at the early stage. I think we need to think about this possibility. And I'll stop at that point. Thank you so much.
Thank you. Thank you, Professor Athukoral. Very important three key points that you raised. And I would like to give the floor to the response of Dr. Samarthunga first, and then to Mr. Muthasa. Dr. Samarthunga, you can take up, and if you have any responses, as well as you can also, I hope you both are going through the questions that are in the chat box also. So you can, I'm not going to read out each one by one, so you can also take up those things so that we can save some time. First, Dr. Samarthunga, over to you.
Thank you very much, Professor. I will, would like to, say, the one or two words about, Professor Athukoral's comments. First, two in particular, the tax to GDP ratio. That is, the completely valid, the comment, by Professor. The second one is, the 1993, the export taxation was done away with. And thereafter, this is the trouble that we have. Until 1993, if you look at the tax to revenue to GDP ratio has been the handsome. It's like the over 20% all the time. It was propped up by basically by export taxation. Yeah. But thereafter only we have this trouble. My thinking is that we were not able to find the good way of taxing the net income and profit, the earners, taxation either. We changed tax, from BTT to TTT and, the GST and then again to VAT. Still, we couldn't fix the problem. I mean, still it's not, that is one reason why we have not been able to come to the good amount of revenue from mid-1990s. This is an area we need to seriously look at and fix it. The concession probably the Murtaza wants to, the step into. But one comment I would like to, say to, when Murtaza was asking whether I would like to, do additional funding for the IRD. Yes, I would like to see this, the US paper, but except in one area, you can, look at, the additional funding in computerization, training, and, the capacity building and so on and so forth, not for emolument area. If you open the emolument area, it's a can worm, that will go across all 17 lakhs of public servants in the country. This is the department. This is just like any other department. We have 89 departments in the country. Therefore, when you touch emoluments to, the help, them, to raise, the additional tax, it's going to create, the innumerable problems, across all government agencies. Except that, I would seriously look at, of course, look at this paper, but, certainly help additional funding for the IRD in other areas, not emolument areas. This is my initial comment. I did not look at this chat box yet.
There's a first one is actually about the serious question, how to raise the tax revenue in a crisis period like this, where GDP is also going down.
It's a multi-billion question, Professor.
Yes,
but I went through recently, what has happened during the Greek economic downturn crisis, very recently. If I summarize it into the situation, for you all to understand, if you earn, the 20,000 euros a month in 2009, that is the year in which, the Greek problem started, you ended up in the problem is over by now, the 2022, they said that they are ready to, pay their debt. So in 13 years time, their GDP has come down to 3/4. Their per capita income has come down to 3/4. In the meantime, had you paid, the $1,000 out of 20,000 pay in 2009, now you are left with, the 15,000. 15,000, but your tax rate is like, if you like, say 15,000 euros a month you draw now, but you have to pay, the 7,500 as tax. How do you like this? This is, the situation of a crisis. This is a very difficult, painful adjustment thing. I don't know how to answer this question, but we need revenue badly. Adjustment internally is the only way out for Sri Lanka. I don't think that, that we have the luxury of Greece. The Greece was supported by, the all 28 European countries and disproportionate by Germany and, the thrice by IMF and so many other, the well-wishers and supporters around. We don't have any at the moment, but therefore the larger part, the bulk of, the adjustment should come from within. This is all what I can say to Professor.
Yeah, I understand the point. Thank you, Dr. Samuthu. There's another question about, that is from
Can
Dr.
I respond to some of the questions that were raised by Professor Thukora?
Yeah, of course. Go ahead, Musa.
Okay. So just to make a point about the incentives for export companies, one has to keep in mind that there are things called countervailing duties. So, for example, when our BOI went and gave tax incentive to certain companies like the solid rubber tire industry, the Americans put countervailing duties against us and we had to go in for litigation, basically. There is also the new development that has happened last year called the base erosion and profit shifting, BEPS. The BEPS 1 and BEPS 2 framework. So the BEPS 1 is about how to tax IT companies that are not resident in your country. There is a regulation from the 1920s that it talks about the establishment principle, that if you're not established in a country, so things like Microsoft, Google, Facebook, they don't have a permanent establishment in Sri Lanka. So they are not taxable, basically. And that got addressed to BEPS 1. BEPS 2 basically says that if you are an OECD country and signed off and your revenues are 750 million euro, if you are paying below 15% of tax in any jurisdiction, you will be taxed at the head office, basically. Now, Sri Lanka is not a signatory to the BEPS, which means that is only applicable to our companies. If they had branches in other countries and earning, I don't think we have a single company in Sri Lanka with more than 750 million euro domestically. So the thing is that we should be a bit more tactical about even incentives to export companies.
Yeah, I agree.
Second thing is the question about the land. Well, that's what the Millennium Challenge Corporation tried to address by giving $65 million, out of which it was to expedite what is called, Professor, the BIM-SAVIA program. It is estimated that we have 12 million land plots in Sri Lanka. BIM-SAVIA only covers about 1 million. So Sam will be able to elaborate that even the government doesn't have an inventory of all the land that it owns, because it's owned by so many agents.
Correct.
Yeah, it's not like railways, and then Mahabali has like 1/3 of the land, and there's no cadastral system. There's no digitized, like I'm a tech guy, but there's no system. I can't go to Google Maps and see who owns what. It's a pity. And we got the money, we got everything to do this and expedite it. And we said no to the MCC grant. I don't know for what reason, but somebody came up with some conspiracy theory and killed it, basically. The next is about Sam's question about salaries. In Mikmua's article, he says that, the Inland Revenue is not the prestigious revenue agency. I believe, Sam knows the reason.
It was
basically where maybe the wrong type of brains going. Now the question is taxation. You have to be smart to collect taxation. So although Sam says that, I don't want to adjust the salary scales, I just feel that if you're going to attract talented people into your revenue authority, basically, there has to be some uniform service or some way to incentivize, like, for example, the central bank, they are on different salaries, basically. Their salary is not as high as a private banker, but it's not the same salary as a public servant. So we have to think out of the box. Those were my... and lastly, the question about how we're going to raise revenue in an economy that's distressed, I'm afraid that the only solution is inflation tax. And we are going to inflate this problem away. That's what we are going to do, because we are not going to restructure the domestic debt, basically. But that doesn't mean that we shouldn't fix the tax policy, and we should do everything possible to try to get the economy growing and not have a distortionary tax policy that works against growth. Now, I have seen some of these models, debt sustainability analysis models, and maybe Sam may want to comment on it or anybody else. That girl who had done it, this was one of Ricardo Hausman's students, she had used a tax multiplier of 0.5. So if we have to get revenue to GDP from 8 to 16, the tax multiplier basically is going to cost growth. There's no doubt about it. Now, the question is, how do we do the taxation to create the minimum inhibitor or distortion? So you want to tax the people who can afford to pay the taxes, not distort. You got to do it very clinically and tactically.
Thanks, Jeff.
Professor, can I comment on two questions?
Yes, I'm going to ask
on the chat box. How to raise taxes without increasing GDP. Of course, Mr. Murtaza, the answer to this question. The different levels of income. You need to bring the relevant people in the tax net. To get the additional revenue too. Without even growing. Without raising GDP, still there is the possibility of the raising additional revenue. IMF matter is still being discussed. We know that it's not come to a finality. It's under discussion between various government agencies and the IMF at the moment. But one thing is clear. It's we need our revenue to GDP ratio is below 10%. It's absolutely unacceptable, basically, even in a normal circumstances, not in the troubled time like this. We need the revenue driven fiscal consolidation, which may be the we may have to go back to the 2019 or above, and Murtaza suggested certain, the certain ways of, the getting, the revenue and, the changes of base levels and so on and so forth. However, we need, the revenue-based fiscal consolidation, because, our revenue levels are, absolutely not at all adequate to, the country's, the level of development and requirement. And as Murtaza said, separate organization, but, the government has to accept it, been suggested from 2000 to set into a different form of organization. But you are right, said that, if you are in a separate set like central bank, certainly you can do, a lot more. This is as of, what is available in the chat box now. Thank you, Professor.
Thank you. Thank you, Dr. Samathonga. I think there are no more questions to my understanding in the chat box also. So that is also right time for us to wind up. And I have two
excuse me, Professor.
Yes, anything?
I put up a question in the chat box. This is with regard to the property tax. Mr. Jeffrey also referred to that.
Yeah, you can ask question. Yes.
Yeah, he wanted to introduce property tax to the tax. Now, my understanding is that property tax is left for the local authorities to charge to meet their service delivery cost. But unfortunately, they do not use this important tax on property efficiently, and they depend on the grants given by the government, and this has been increasing the grants. I mean, now it is around 50%. So inefficient local authorities are maintained by grants of the government, whereas the potential is so much there for them to collect tax through the property tax. So what is the, local authorities as well as the provincial councils, they are the service providers at the provincial level as well and the local level. So I think the center will have to consider, otherwise center has to provide grants to keep these institutions. This is my question. Thank you, Professor.
Yeah, I think Dr. Samathonga can answer that. It's Dr. Sumada.
We Professor, we have three layers of government, the center, the provincial council, and local government. Local governments are very much older than, the whole other forms of government. They had, the olden forms of, the various taxation at the lower level to service, the local, whatever the requirement. But the thing is that property tax has not been, properly looked at in our tax books for a long, long time. Only very recently, as he rightly suggested, that, the property tax being, looked at by local authorities. It has to come to, the center, the formulate policies and real taxation policies has to be really, looked at by the center, not, should be left to, the local government to do. The local government, of course, can, implement it and, the collect revenue. Also, the provincial council on property, on tax on property. But the thing is that, this has not been, properly looked at by, basically by taxation commission as well. We look at, the whole other direct and indirect taxes, not property tax, in particular. But, as he rightly said, that is an area which we can, we look at, the revenue-driven fiscal consolidation, the raising, the direct taxation and so on and so. But we never looked at the potentials of property taxation in this country. That has been neglected for some reason. It cannot be handled properly at the local level as well. But there is no proper organization or the policy formulation process enabling them to, they implement those things. Therefore, it should be handled first at the center and develop, the policy, just like any other, the taxation policy. Then, the implementation can be, given to, the provincial council and local authorities, so any other authority that may collect, the taxes for the government.
Can I just make a comment here? This is one of the slides that I skipped because there was no time. Please take a moment to study this. This shows you on an index what happened to land prices from the end of the conflict. This is Colombo district land prices. Yes. And what it is showing is the significant growth that we have experienced in land prices over this period of time, right? So the amount of wealth accumulation has far exceeded any other asset class, may it be equities or fixed income. So the largest wealth generator in Sri Lanka, in the rich, has been through property. Okay, this is land prices. This is not even built up property, which is another component. Now, the economic imperative of why we need to tax land is basically, it is considered a hedge against inflation. So and as Joe Stiglitz, when he came down in 2016, he says, look, you can't take the land and go, but capital can move and labor can move. So basically, if you tax the high income earners and they have very high skill, they can decide to leave the country. Of course, they're not going to leave Sri Lanka due to taxation, but this problem is there in the US, where people are moving from California to Texas, etc. Then you have the issue of capital, that if you overtax capital, now we are trying to put super gains tax, retrograde taxation, which is very bad, the capital can always go away. But land, you can't take it and go with you. It's an immobile asset. The second reason why we have to think about property taxes is that when we are going to impose inflation tax is going to significantly impact financial assets. So people's willingness to hold financial assets are going to come down, and they are trying to move into real assets. So even preceding this crisis, basically, people who were smart enough for switching into real assets, there was a massive bull market long before the bull market in the equity, which crashed. There's a massive bull market in land prices over the last 2 years. And therefore, I am making, and my family is going to kill me because we are having a lot of land. We are a big landowner in the city of Colombo. But the reality is that basically, I mean, this is an asset class that we should tax. Yes, Dr. Sumanadasa mentioned that it's the local government revenue. And when I did that course at the Kennedy School, I mean, we had the city of Cambridge, where Harvard is located. And those people from the city, I mean, they were collecting $750 million from property taxes, basically, because they had all these life science companies that had all these big buildings, basically, in the city of Cambridge, from which they were charging like 1.5% of value. The amount that they charge residential properties was significantly lower. So if you come down to the city of Colombo and see the amount of properties that have been developed, the tall buildings, we are not taxing them, basically, and we should. And that's how the provision of local services. Look at the roads. We are building flyovers. We are building overpasses. We are tarring the road. I mean, I'm presuming, Dr. Samaratungo, all that is coming from the general budget, and the RDA has huge amount of borrowing. So why can't local property taxes pay for all this?
Thanks, Jeff. I think these are fundamentally important issues that should be taken up at the forthcoming discussions and negotiations and reforms as well. I don't think there are any more questions and comments in the chat box. Also, I don't see hand raised. So that it's time for us to getting closer to 1:30. It's time for us to wind up the session if there is nobody. I just want to raise 2 points as concluding remarks. And obviously, at this turbulent times and crisis time, we need tax reforms as part of the recovery program. And in that case, as Dr. Samarthanga and Mr. Jafferji, both of you mentioned, I got out of your presentations that one thing is obviously I'm not sure how capable we are handling this political issue, but this is the right time to handle that. And there is no any other right time to handle these kind of issues, because crisis always gives us opportunities. The second point I want to mention, particularly, Mr. Jeffrey also mentioned that, and that is the competency in our tax administration system, the resources, the human resources, and also the abilities to provide, to come up with innovative, creative tax systems and scientifically innovated tax system. So this is another issue that we need to handle. So the two issues, I hope that this is the right time to address these fundamental issues, which we have not been able to address the last couple of years, if not decades. So with that note, I want to thank both presenters, Dr. Samarthunga and Mr. Jefferji, and also all the participants and Professor Athukorala for spending time with us. I could also see Professor Sisira Jayasuriya, thank you for joining us, and all the participants, the members of the associations, and all the guests joining today. Thank you so much, and we will hope to meet you again in a productive discussion webinar series, and there is another one coming up. The fifth one is coming up very soon. Thank you so much, and good night, everybody.